Hello guys and girls, and welcome back to another episode of Quick Tips. So we're now at episode 6, which is going to be covering running channels and the middle section. I'm really excited for this episode because this is just a tiny little detail, but it's so important, and it helps to keep you more in tune with the probable and the possible. And the more and more we can do that, we can move towards being more neutral. And the more neutral we are, the better traders that we can be, because we can make more calculated decisions and be much calmer in our decision making when placing trades. And I honestly believe by understanding that with the middle section and understanding these running channels is going to give you that edge. So let's dig into it. Get ready to take some notes. So with our first example, we have oil here. So this is really important to understand what gives us an edge here. Where if we look at the overall structure, we're looking at this overall big ascending channel. We have a break, and we was looking at this as a retest at the back end of the trend line. As you can see, we broke past that in the form of an ascending channel. So we could see this is just an extension. This is just an extension of a channel for eventually this to impulse down and achieve the 90% rule as a minimum and potentially go all the way to the lows, right? So at this stage here, it was understanding how could we take advantage. Now, this was definitely a trade that I got a bit distracted on and I didn't capitalize on it, but I know so many people took lots of trades. Now, we know in the impulsive legs of oil, it tends to give us a lot of continuation. So let's look at it in a bit more detail. Now, if we go to the 1 hour chart, this is more to do with running channels rather than the middle section in this part. So if we go over to this area here, we can see what do we get? We get this overall move up, impulse, correction, impulse, correction, impulse, correction. And it's at this stage, we're getting close to these outer structures here, and we're looking at this overall channel. Now, we started to form this section here, which we can see that after we got this rejection off of this, we then started to form this ascending channel. So we was getting an ascending channel within an ascending channel at this stage. So we're looking at this little section thinking, well, do we need to get right to this outer structure here, or could we drop a little bit earlier? Well, we could, because it is possible, and we do have an ascending channel within here, and we started to get this almost head and shoulders type feel to it. Now, we was looking at this, and it goes back to the probable and the possible. Again, if we just remove this for a second, we could have this structure like so, and almost look at it like this. Well, this kind of applies a little bit to the middle section because the running channel links with it nicely. Well, you could say this is the move up, this is the middle section, and here's the move up. 1, 2, 3. We're looking at the outer structure, looking for that third touch. Well, what about the probable and the possible? This is probable, this is what's possible. Now, for the middle section here, for this to play out to the downside early, what does it likely create? Well, it creates the running channel. Well, let's take a look at that. What do we have? 1, 2, 3. And if we look at this in a bit more detail, how do we get here? We get here correctively, like so. And if we go to the 15-minute for the filter, and key thing that I said is a filter, right here, we can see that we get that running channel. So what does that give us an edge? It's understanding that little detail there. Here is the probable, 1, 2, 3. Here's the possible. Impulse, correction, middle section. Middle section fails to move to the upside for the probable touch. We get the possible with the running channel. We get the impulse, correction, and then so on with lots of other trades along the way. But as you can see, just a tiny little detail here, and I remember this one would have banked with my normal trading plan just under 8%. So definitely an 8% move that was a fantastic one just by understanding that concept. And the reason why we take these trades is, again, to avoid being a perfectionist, because it's not about perfectionism. It's about having that probabilistic thinking and understanding the possibilities also. So this is a great example of that, and you can see how it links to the running channel. So I hope you took some tips there. And the next time you look at something like a running channel, just take a look if there's a middle section that links. It often gives you a clue. So that is oil. Let's take a look at the next position. So for this next example, we have Kiwi CAD. And what I love about this one is that we have the overall double top type formation and the higher time frame structure in alignment of it. The one thing I want you to take note of with running channels is they're typically in line with big reversal moves. So the running channels often are the trigger point, which gives us that bigger move to either to the downside or to the upside. So when they're at the top of structures, they have the highest probability. They're not the most common. They're not as common as, let's say, an ascending channel or descending channel or a continuation bear flag or bull flag. They're less common than that, or an expanding formation, but overall they provide us with a great edge within the market. So we have the high time frame structure here, and if we drill our way down, we look at the 1 hour chart here. Now, firstly, you can see this particular one that I spoke about in the previous quick tips and in some trade recaps is this running channel here. So what do we have? What's the key difference with them? Well, essentially, what a running channel is, so you understand, is this. Let's say, for example, we take this structure and we put it, let's remove this. Let's say if I was to take this structure and we've got the double bottom, and if I was to just piece this bit of information to here, if I was to put this down here, what would you think? If we had that, what does that look like? That looks like a potential for a buy setup, right? Potential move down and a move up like this, right? You're looking at a double bottom area, you look for a buy, right? But you have to look at this variation. Where do we come from? We come from an impulse, and we're in the state of a continuation. So this is a type of structure that can often confuse people, thinking, well, this is a reversal to the upside. Well, you've got to zoom out and look at where are we within the structure. That's the key thing there. And what you have to establish is that, well, what is a running channel? Well, essentially, quite simply, if you take a formation like this, let's say you take an ascending channel, we'll do both. Let's say you have price within here moving up, you get a correction like so, you're expecting a move up like this, you're expecting this to be a reversal, right? Typically, you'd expect this to sell off an ascending channel, 1, 2, 3. Well, what would be a variation? Well, if this, it's how it moves to the downside. If it moves impulsively, like an impulse, a correction, we'd expect a sell setup. If, however, it starts to move correctively, the running channel forms a continuation pattern at the end of its channel. So then what that would be? That will give us a clue that we're not breaking to the downside, we're breaking to the upside, because what we actually have is impulse, correction, continuation. So you can see the key thing with the running channel is for you to ask yourself, what do we have at the end of the pattern? And if we're looking for, let's say, a typical sell setup, but at the end of it, we have an impulse up and a correction that has a descending channel, then that can move and break out to the upside and can be a running channel. So just a key little tip there. And if we look at the same thing on the flip side, which is what we're looking at now, it's exactly the same. Now, quite commonly, we see it more for sell setups. We see a lot more running channels to the downside that play out. So, for example, we'll see an impulse, and it will look like a descending channel like so, and then right at the end of the descending channel, you'll see a correction like this, and it will look like, right, we've got descending channel, we're looking for a buy setup. And then what happens right at the end, we get the ascending channel like so, and then it just drops out like that. That's a clue. Now, where this normally happens is that if you have the higher time frame, and you'll notice that these running channels form in the middle of nowhere, where people would think, oh, there's a reversal to the upside, and they might have some kind of support in there or something like this, and think that, you know, it might have rejected, see, here, and think that's some sort of support. And this is why I believe that support and resistance sometimes can hold you back, because you're not looking at the current price structure, you're just looking at random bits of price that bounced off and holding it as significant. But the truth is, it's the most current price structure is the most accurate, and we've seen that in the data for years and years and years. So looking at this type of structure, what does it have at the end of it? What's the key characteristic? Key characteristic is that we have what? An ascending channel at the end of it for continuation. So that's a little tip there, and you're going to see this more and more often. It's not the most common pattern in the world, but certainly something that you should be aware of. And as we play out, we actually move into a slightly bigger one that I believe, as we start to form here. You move to the downside, like so, and you'd be expecting some kind of move up, if it moves higher at this point, to form some kind of running channel, right? So here we are, moving a little bit higher, like so. And there we are, we're forming the running channel, right? Right there. So as you can see, similar type structure. And what happens to this one? These can still break to the downside. And the bigger they are, the more momentum they have. Now, what you can look at with these, one little variable will always be that if this plays out to the downside, it can reject, create a double bottom, and move to the upside. Of course, that's possible. But what you do is you take the trade in the mindset that it doesn't have to do that. If it does that, you've already got a management plan for that, so it doesn't matter. And if you end up banking 4% and you have to flip your bias if you like, and then move to the upside, that's absolutely fine. But to be paralyzed by that and think, well, it's a descending structure, so I won't take it, this is why you can't look at something so black and white. And you have to ask yourself, well, it doesn't matter about that. What matters is what's the risk to reward. Well, if there's 7% from here to here and it rejects, is it a good trade? Yes, the risk to reward's there. I risk 1%, there's a 7-to-1. If it rejects, then guess what? I'll bank my profit and then I'll move to the upside. If it happens to be a running channel and it continues, then I'm in a fantastic trade. It's a very, very simple thought process. And when you see a pattern that is a replica of a similar pattern that just repeated itself, it has an even higher probability of playing out. So the fact that we've got this running channel and we had a previous running channel, this statistically now has a higher probability of playing out. So just a quick tip there for you guys and girls, and I hope that helps, and a great example of how running channels play out. Let's take a look at the next example. So taking a look at this next example, we have USD CAD. So as you can see here, we have this descending structure. So if you look at that descending structure, typically what would you look at? You see this descending formation as a move to the upside. What's the key characteristic that we have at the end of it? Well, you guessed it, we have the running channel. So what we have is we have the ascending formation at the end of it. And what can we do? We can use pattern separation. So if we utilize pattern separation, what can you see? We have this descending type formation, and then we have an impulse down and a continuation. Impulse, correction, continuation. So pattern separation helps out massively. Now we have to look at the context of this and zoom out. So if we go to the 4 hour and we take a look at the structure, where are we within the structure? Well, we're playing this impulsive leg. So again, like I said, with the running channels, they're normally in alignment with the high time frame structure. And if we look at this low here that we're targeting with the 90% rule, as you can see, we still have a lot of room to go to the downside, so that makes sense. But what would put you off taking something like this? Well, again, people thinking that maybe there's some sort of level of support in here. Now, maybe not in this case because there wasn't really anything. You know, you could argue that some people might think there is support there, and they may want to close some profit down, etc. But the truth is, the 90% rule is far more accurate to play it to the downside, as we was talking about for a while. And right at the end of it, we happen to have that running channel. So the next time you look at a running channel, ask yourself, as the quick tip, is where are we within the structure? That's the real question that you want to be asking yourself. And as you can just see there, very simply, descending channel, impulse correction, as clear as day, as a continuation to the downside. So there's always a good opportunity to look at a descending structure or an ascending structure and ask yourself, what is happening at the end of it? That's the question that you really want to be asking yourself. That's USD CAD. Let's take a look at the last example. So with this last example, we have CAD Swiss. So with CAD Swiss here, let's take a look at this price. This is really, really important, and it links again with the middle section. So what do we have here? Well, essentially, if we were to forecast the probable and the possible, what would we do in this situation? Well, we would take a look at it like this and say, well, we have our 1, 2, 3. We have the bigger double top. Let's look for a high probability here for a sell. The ascending structure, the 90% rule to the low here. What else do we have? We have impulse, we have correction, continuation. We would look at this as the middle section. So this is our middle section here. Now, what do we have with the middle section that I said that links to the running channel? Well, quite often we'll have a running channel at the end of it. So the middle section doesn't actually complete for the third touch and it goes early. So essentially, we're looking at the middle section and then we're utilizing the running channel theory to give us an edge. Why? Because if we was only focused on the middle section, then we'd be blinded. Our mind would be saying, you know, this is the middle section, so this, you know, this has to do this. This is where we get our ego involved, and we're only thinking about probabilities. We're not thinking about possibilities. This is why it goes back to the core concept that I've been saying for years: probable and the possible. So what's the possible? Well, we look at that and say, well, this is the running channel. We have the ascending channel at the end of it. Well, what are the possibilities here? Well, essentially, like I said, you still take the sell setup, knowing that you have to be on your management game, because it can create a double bottom, reject, move back to the upside, and then sell. Well, if you don't take it, what are the other side of it? Well, if you don't take the trade, you'll forever be waiting for perfect trades. You'll be being a perfectionist. So essentially, you have to weigh up the risk to reward. So if you look at something like this, and we're looking at this structure, essentially we just pierce through, like so, like this, and then we had a trend line here and then a rising wedge type channel like so. And if we just play it forward a little bit, then we start to drop down within this. So as you can see, just evolved a little bit, and then that makes sense. And if we go to the 1 hour chart like so, you ask yourself in that situation as it rises like here, what would be the risk to reward when you're rising like this, looking for this to break to the downside? Well, essentially, with the risk to reward, if you've got a break below here, let's say you're looking at a 25 pip stop, and you know to the downside is 2.7, maybe for a double bottom if it breaks about 3%. It's pretty much a 3 to 1, right? So you ask yourself, I've got a 3 to 1. If it breaks to the downside and rejects and then moves to the upside, that's fine. I can then flip my bias, if you like, and then look for that buy to the upside and then look for the bigger sell. Or if this becomes a running channel, then I'm in for a great trade because I'm looking at more downside for 14+%. So it's about having that probabilistic thinking and just having a management plan to be able to deal with it, utilizing the middle section in your favor, and then understanding how the running channel can be in accordance to that. So I hope that helps give you the thought process that just because it has a middle section doesn't mean that it should play out. And quite often we can force our beliefs, because who doesn't want a perfect pattern? Who doesn't want a completion of a 1, 2, 3 impulse, correction, continuation, and sell from there? Of course, and it does happen. But it's just about staying 10 steps ahead of the market and understanding how to deal with that. Now, it may not be so visible on the daily, but as you break your way down to the 4 hour and the 1 hour, I encourage you to take a look at this across the board and utilize it as your edge. So remember, keep thinking with the probable and the possible, and make sure that you're making yourself as neutral as possible. So be neutral and let me know how you get on. And I highly recommend that you just back test this. So go through lots of pairs, see them, go through the examples that I've shown you. And as you see more and more of these channels play out, it's going to have more of a probabilistic edge within your mind. You'll start remembering, right, so this has a middle section, does it have a running channel? And that will prompt that thought process. And that is just a quick tip in your mind that's going to give you that 1% tweak. Let me know how you're getting on, guys and girls, and I'll see you in the next episode.